Let's look at emerging markets. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. We have emerging markets here, 82% from the 52-week low, pretty close to the highs. The thing is that if we look first here at the seasonality, we do see that February is basically 50-50 month, and it is April that is like the super month for emerging markets, where it closes higher 72% of the time, which is, pretty darn impressive statistic, given that this is the last 20 years. That's interesting. If we look at the current chart, so this is all the data we have for the EEM, we see that we've been in this monstrous consolidation range ever since, the top of the prior bull market, which means that it has taken a long time for the emerging markets to break out. Clearly that's, a sign of weakness. You see that here we attempt to break out, but we didn't get close. We are breaking out now, so this is of course a bullish sign. However, if you do adjust for inflation, then we do not have that breakout situation. But because the algorithms and the people are looking at these charts that are not, adjusted for inflation, then this will be interpreted as a breakout. It is bullish to have a breakout, but if you look at, the S&P 500, that one had a breakout, already in 2013. Hence, sure, it is bullish to have a breakout, but it's been a long time coming, and you can see that throughout this entire post housing bubble bull market, the EEMs have been kind of doing their own thing. We could argue that this was a bear market. I mean, minus 45% is quite bearish. From this high to this low, that was 798 days, minus 41%, definitively what you can categorize as a bear market by any definition. So there are, different ways to interpret this. There are many who would say that this entire phase is one bull market, but quite clearly, when we do some measurements, there's a bit more of a complicated story here. If we do look at the accumulation distribution, we do see something interesting, because given that it's been stuck in a range, it becomes even more interesting to look at whether buyers or sellers are dominating. And you can see that throughout this entire time frame, there's been a steady increase in buyers. So there are definitively, bigger institutions that are putting money into emerging markets at an increasing rate. So they're clearly dominated by buyers. That's of course bullish. What is a bit problematic as far as entry right here and right now is that RSI is it's reached a level that has been problematic multiple times in the past. You have times like here, and here, where overbought RSI basically told you that the top was in and we had a big crash. But we do also have these phases like here, where we were able to be overbought for an extended period. And also here after that big crash. Something that complicates the situation for the bulls is when we combine the RSI with the PPO. You can see that we currently have a PPO level that is very high. And if we compare it as an example to this situation where we were overbought for an extended period, this high PPO level that we currently have, that happened towards the top of that major rally. So we have a bit of a problematic constellation of factors here, both overbought RSI and very extended PPO. Let's look at the correlation, 60% with the S&P 500. If you look here at the daily data points, like that, something that I do find a bit interesting here when we look at if we compare this and this major rally. Let's measure how extensive the move was, so like that, and let's measure this one as well. So 87% over 312 days. Here we have 88% over 745 days. Another thing that is similar here is how the rally occurred. First, you have this initial rally, and then you have a sizable pullback, and we see something similar as well. You see that this pattern is similar to this. Then you have this big move upwards. So there certainly are some parallels here. Okay, let's just remove these like that and like that. Okay. If we look here at the PPO on the daily data points, this measures the distance between price and the red 200-day moving average. The 200-day is arguably the most important of all the moving averages. We do see that the current level was very overextended vis-a-vis most of this entire history except this recovery. Hence the pullback that we did recently have, which shouldn't really have come as a big surprise. The big question is, of course, what is going to happen next. But I think we need to explore a bit more data before we really make, draw some conclusion. So here you see Finwiz, they draw these trend lines. We did push up into the higher end of that line, but we do have potential support here on the blue line. So options are available. It is also shortable. If you look here and compare the PE with the S&P 500, EEM and S&P, we do see that the EEM is, PE is minus 26% lower, so significant discount. The dividend is very similar, 1.54 for the S&P, 1.40 for the EEM. If we look here at the holdings, so let's see how diversified it is. So a very nice balance here between the sectors. So that actually is pretty good to see. If we compare it against the S&P 500, if we look here at the market cap breakdown, large and mid cap dominate, no shock there. Something that is important to be aware of when comparing the S&P 500, as a benchmark against all kinds of sectors and so on and so forth, is that the companies here in the S&P, these are, global, huge giga companies. Hence, this is a America ETF, but it kind of is, a global stock market ETF as well, due to the size and reach of these companies. Okay, so to sort of sum up my take here on the EEM, looking at the seasonality quite clearly, we do have Super April on the horizon. The charts, it was a very mixed message because on the one hand you do have that breakout. Breakouts is something that it is interpreted as being very bullish. So there's that, it's a very bullish sign. There's a lot of attention when there is that event. What is a bit problematic for the EEM is that it happens after we have, this monster rally. An alternative way to have made that breakout would be to do something. So let's say that we are here. So if you do something like this, and then have the breakout, because by using more of that time, it creates a situation that is easier to sustain and have like a very strong breakout. Because the RSI and the PPO, they do put the bulls in kind of a bit of a crappy situation because, they are already, so overextended. And this is an important event. I sort of you can compare it to sports. If you have, the bull and the bear team, and let's say that, the bull team during the break, before the next round of the game, you have, the bears resting while the bulls, they don't rest, they don't take a break. They are exercising in the break room. And when they get out there on the field, they've used a lot of energy. So that's not the issue here. I mean, why couldn't they just had a bit of a break? Okay. Yeah, long-term looking years into the future, based on valuations and the clear trend we saw here with the inflow of money, I am bullish on emerging markets. I think there's a good chance of outperformance vis-a-vis the S&P 500 for sure. Looking at the coming months, I do think that maybe we used too much energy, that there's higher probability of maybe some pullback or that we will consolidate a bit.